Hello everyone, I am Sia Anshubudia and here we are today meeting for understanding the first topic of your PM subject. See, before we go ahead for any of the subjects, it's very important for you to understand what are the basics of that subject. Because you will never have clarity of the subject unless you are very clear with the basics. So today I am going to be starting with the most important portion, which is basics of your costing. So guys, even if those who are watching maybe for MA purposes, for APM purposes or for PM purposes, these basic concepts will be relevant for all of you. And also if you are coming from MA category, you have cleared your MA paper and now you want to appear for your PM paper, then it is relevant here as well. With the only reason, when I know most of the students, they find problems when they are not clear with the concept. Okay, they still find difficult to understand like what is absorption costing, what is ABC. Okay, or for that matter, why does a cost is a direct cost and why does an indirect cost may be an indirect cost. Like for example, a labor cost can be a direct labor cost. However, the labor cost can also be a part of indirect labor cost. So it's such a confusing question and you will have all answers to it once you are absolutely clear for it. Okay, so in today's lecture, what I'm going to be focusing on will be to making your concepts absolutely clear as regards these basic concepts of costing. Okay, so the first thing is to understand why do you calculate cost? Have you ever given a thought of it that why do we need to calculate cost? What is the need that there has to be cost calculated? Okay, anybody would like to give any answer? Okay, so I think now I believe that I should be giving this answer that why does there is a requirement of us to record cost or us to calculate cost. I think first thing that comes to everybody's mind is, ma'am, we need to record cost to calculate profit. Absolutely correct. But then we also need to record cost for our inventory valuation. The reason being, you cannot value your inventories unless you have the cost details, because at what value do we value the inventory? We record inventory at lower of cost or net realizable value. So I need the cost component to be there. So first and the foremost reason why do I need to calculate cost is I need to calculate the cost of a unit or a product or a service for inventory valuation. Then I need to calculate the price of the product. For that also I need it, because generally the approach is cost plus margin and you get your pricing. But of course, when we do pricing topic, you will understand that there are different ways of fixing the price. Okay, but here I'm just taking a very simple example of that. Now then we get profit margin and then accordingly the cost function gets played. Done. Now comes the second topic. Then now you know why, what is the role of costing in the business environment. Okay, typically why does a business needs to calculate cost? Second topic is, ma'am, what are the different types of cost? See, that cost can be calculated according to the different categories based on various, you can say, criterias. First criteria is based this on the nature of the cost. So the nature of the cost, we have a direct cost or an indirect cost. Okay, the cost can be direct cost and indirect cost. Now for that I will take the example first of a pencil. See, I have not taken you to the study text so far, because in every class we will begin with understanding the concepts in these handwritten notes area, where of course I will beautify it more in the the upcoming sessions that we have. Now of course, so every time you will first understand the concepts and the technical details in these notes, and then only I'll take you to the study text which I have custom created, and then you will have a question bank where you can do more and more questions. Now, just a small appeal to all of you, those who are watching the video, in case if you have not liked and subscribed to the channel, then please do that, because you will get updated with, you will be updated with lot of contents, lot of new portions, and lots of exam related material. Anyways, let's go further now. So if I take the example of a pencil, now just think, for a pencil, it's a pen. Okay, so for a pencil, what can be the direct cost? The direct cost can be its wood cost, its graphite that goes to make the lid, right? So that is the material cost. Material cost would be the wood and the lead, for example, that is the graphite. Then I need labor who would be assembling these products and putting the graphite lead inside it, fevicol, and putting it into the wooden bracket that we create, right? So I need the labor to do that, and this labor is only doing this task. That means if pencils are not going to be manufactured, then I do not need this material and I do not need this labor service also. I don't need them if I'm not manufacturing the pencil. So for me, for manufacturing the pencil, I need wood and the graphite as my direct material. My direct labor would be the ones who are manufacturing the pencil. I can have some direct expenses also. I mean, see, because lead will not get fixed unless you put in glue. So I need glue to fix that lead. I need glue to put that plastic paper that we have on the wooden pencil, like we have the Nataraj and Doms and so other wooden pencils. So I need glue to stick that plastic as well as to fix the lead. Now you would say, ma'am, I we also need glue to maybe fix the carton. So boss, carton is something that is not my direct cost, right? The carton, there are two type of cartons. First is when you have 10 pencils and you put them in a box and keep it in a sale, you sell it. Or the other is when you have 10 boxes and you stack it in a box and then it is sold to the shopkeeper. So both these carton costs will be accounted for separately. Why? Because the initial 10 pencils that you're putting in the box, and then it is you can say that now this product will be in a saleable condition, is my primary packing cost. Primary packing means this is the basic packing cost without which I really cannot sell the product. I mean, I really cannot make it in a saleable condition and this product cannot be sold. Because when you go to the market also, you need that box, right? Very rarely we find only pencils being sold. So we have that also as a direct expense, right? So I can have this direct material, direct labor, direct expense. Now why do I use the term direct? Did you understand? I use the term direct because if this is not manufactured, then if this is not manufactured, then direct material, direct labor, direct expenses are all saved. That you don't need to incur on these expenses, right? Because then since pencil is there, not there, we don't need wood and graphite, we don't need the labor who will be assembling this, we don't need the glue and all, and we don't need the initial pack carton cost also. So I don't need any of them, hence these are my uh, direct expenses that I can do without them also. Correct. So this cost gets saved when you are not manufacturing this product. And so remember always, the cost which can be saved when you're not manufacturing that product is your direct cost. And the cost which still will be incurred whether you manufacture this product or not, like rental expense of the factory, like the supervisor's salary, like that big carton box that we have, because we may not be able to use it for pencils, but let's say if they are manufacturing erasers, this box can be used for erasers as well, the shipping box that we have, right? That is only secondary packing. Then I have this indirect labor like supervisor who is on the shop floor and supervising lot of manufacturing products. He is not just hired for only pencils. He will look after the manufacturing of pencils, erasers, sharpeners, all. So therefore is the common cost, right? So these common cost we call it as indirect expenses. Indirect cost is nothing but a common cost that we also term as overheads, because these costs are over and above your direct cost. The direct cost. Okay, so like indirect labor, I gave you the example of supervisor salary. Okay, secondary packing cost, I gave you the example for indirect expense. Indirect material can be any other thing. Maybe I'm just giving, a cap on the pencil. So even a pencil can be sold without it, but just to make it more advertisable, I am giving a cap as well, right? So it is my indirect material cost. Got it? So now whether I sell the pencil or not, maybe my all of these costs will be still be incurred, because the free item that I'm giving with pencil, maybe I'll give it with eraser, right? So it is not that only when the pencil is manufactured I will be giving it. So all those costs that is not saved if you stop the manufacturing of that product is your indirect cost, like indirect material, indirect labor, indirect expenses. Clear, absolutely crystal clear what is a direct cost and what is an indirect cost. Now guys, when we prepare the cost sheet, so please look at the screen. For preparing a basic cost sheet, this you would always need when you are solving questions or doing a lot of things. So like here I will be giving you an example of basic cost sheet. First, I start with all the direct expenses. So I will take direct material cost. With this, I will take direct labor cost. I will take direct expenses. The total, you do it and you call it as prime cost. Okay. Now, prime cost, with this, when you add production related indirect cost, that we call as overhead. Production overhead cost. For example, supervisor, because he's on the shop floor. So any additional indirect expense that is relating to the production activity, like depreciation of machinery, okay, like scheduling cost, like material handling cost, like production run cost, all these are related to your production activity, but they're not direct expenses, they are indirect expenses. So we call them as indirect expenses relating to your production, right? And hence we call them as production overhead cost. Clear? They are production overhead cost. Overhead, why? They are indirect cost. And I'm sure now you know why are they indirect cost. Okay, now let's go further. And now I will add the production overhead cost also. So here I get total production cost. Why? Because this direct cost is also related to production. So you can say that this is your production direct cost. And this we already know is the production indirect cost. So when you add the two, you get here total production cost. Oh, I'm sorry. Got it? So we get here total production cost. Now with this, I will add general administration overhead cost. With this, I will add selling and distribution overhead cost. Okay, now when I say overhead, as I will tell you again just sometime later, it will include two type of overhead cost: variable overhead cost and fixed overhead cost. So that I will just take in the next part. Okay, now you add here the selling and distribution overhead cost. Now what is general administration cost? Like for example, along with the factory we have office space, and let's say we have the heating expenses and the lighting expenses of office. We have the AC expenses of office, we have accountant salary that has got nothing to do with production. But then we need that accountant to run the company, right? So therefore, I need these ancillary costs. A proportion of all these costs will be a part of your total cost. Okay. And if we are doing the pricing of the product based on total cost, then yes, this will also go to your product pricing as well. Okay. Now, so general administration overhead cost, we have selling and distribution cost, like your selling expenses, advertisement, promotion expenses, all this will come here. Okay. So now we add it, and I will add all this, and then I will get here total factory cost. With this, I will add profit margin, and I get here selling price that we would be charging on the of the product. Okay, so this is a basic cost sheet that I presented here, and I'm sure that now you guys are clear with how do we calculate the selling price of a product when we are following the total cost approach. Here, if you observe, there is a point that I mentioned here, profit margin. And trust me guys, I have found students to be always getting troubled with 2 points. One is profit margin, and another is profit markup. Okay, profit margin and profit markup. Now, what is the difference between profit margin and markup, and how do we calculate it? I think it is very, very important for us to understand, because this is a basic point that will be applicable to you whether you do FM, whether you do PM, or you do FR. I mean, you will find it everywhere, this pointer. So let's have the basics absolutely clear, and so that you will never be stuck with this point of what is a margin and a markup. So I'll give you one format, and based on which we will calculate. So this is the format that I'm giving you, that you will never forget, and this is the format that we will use always to solve whether it's a margin question or a markup question. Okay, so let's take the example. Now here, let's say you know the basic relationship of selling price and cost. That selling price, or I would go reverse, cost plus profit is equal to selling price. Yes, we know this equation. When we add with cost, when we add profit, I get selling price. Correct? In the cost sheet also, I had explained this. Now, we will always take an assumption where I'll take cost as 100, profit as 20, for example, and this will become 120. Now you will say, ma'am, what is the relevance? So like in maths, we do proportions. Here also we will do proportions. How? Look here. So let's say I have a markup question or a margin question. Here, let's take an example. The question says, calculate what is the markup to be done. And markup is always done on cost. Margin is always calculated on selling price. That is sales. So you need to have the base clear. When it's a markup question, I know I need the base to be cost. That means if the question, let's say, is giving me that what is the markup on cost, if first example, if the cost price is 200, it's very easy. Now you know markup is always on cost. So in this case, your profit will be equal to, let's say, the profit percentage is 10%. Okay. So now in this case, the profit will be equal to 10% of 200, which is equal to 20. Clear? Let's take another example, and in another example question tells me that your selling price is 300. Now find out what is the profit if it is on markup. It is a markup on cost. Now I don't know the cost, but I know selling price. Now look at this format. In this format, selling price is equivalent to 120. I need to find out what is 20. Correct? So this is my selling price given to me. I need my profit, and profit is on cost. So here I can calculate my profit is equal to 300 multiplied by divided by 120 multiplied by 20. Just use this format. I repeat again. I need profit. Profit is equivalent to 20. Selling price is given to me, that is equivalent to 120. So use this proportion. If selling price is 300 divided by 120, that was the proportion of selling price in the format. Profit is equivalent to 20. Your profit is equivalent to 20, so multiplied by 20. Now what do you get here? Let's do the multiplication. I'll do it on the calculator. So I will take here 300 multiplied by 20 divided by 120. I get here 50. Can we just cross check? Let's see. Okay, let's see. Wait, no, I will not take 20 by 120. I'm sorry. I did not see the profit percentage here. Because here in this example, we had taken profit to be, I'll just do the correction. We had taken profit to be 20% on cost. And here in this question, I've taken profit to be 10%. So I need to create the format again. So that means if profit is 20%, we took 100, I took 20 and then 120. If my profit is 10%, you will take 100, correct? You will take 100. Cost, profit will be 10% of cost. So selling price will be 110. Now you will use this relationship here. So divide by 110 and multiplied by 10. What do you get here? 300 divided by 110 multiplied by 10. I get here 27.27. Can we cross check? Let's see. So if my selling price is 300, profit is 27.27. What is your cost? Cost will be 300 minus 27.27, which is 272.72. Okay, now let's calculate 10% of it. So 272.72 multiplied by 10%, I get 27.27. So my answer is absolutely correct. Got it? So you will always reform this equation with the help of what is the profit percentage given to you. Let's take here also. If the question is asking you profit and it is a profit margin percentage given to you, margin is always calculated on sales. What does this mean? That in case of margin equations, so this is the format for markup. I will write here. This is the format for markup. Okay, now what is the format for margin? I will mention here. Format for margin question. Now guys, what is the base here for margin? In the margin questions, what is the base? Base is selling price, right? In margin questions, the base is selling price. Correct? So I need selling price here. Selling price will be equivalent to 100 then, because for margin question base is selling price. So I need selling price will be 100 then. See, whatever is the base that becomes 100 and then you calculate the remaining equation. Okay, and profit is on margin. That means profit is calculated on selling price on the base. So the profit will be equivalent to, let's say the percentage is 20% only. Okay, so the profit will be 20% on selling price, which is 20. So what is your cost price going to be? 80. Reverse. This is the relationship now that you have created. So whenever you do a margin or a markup question, please create this relationship and you will never have any problems. Okay, now let's take two examples here also. Let's say first example tells me that selling price is given to you 200. So what is your profit going to be? You know that profit, and let's say the question gives me that profit percentage is 25%. Okay, now before I proceed for anything, I need to create the format again. So I will create the format again. Right, so format will be, now my selling price is 100 because it is margin question, so I need the selling price to be the base. Profit will be now 25%, so 25, so my cost will be 75. Now you got the equation, solve it. So now if selling price is given to you, it's very easy. So now the profit will be 25% on sales because margin is on sales. So it will be 25% on 200. So that will be 50. Got it? Now, let's say if the question is giving you that cost is equal to 500. Now, what is the profit? You know the format, right? Use that format, and you know cost is equivalent to 75 and you need 25. So, what is it equivalent to? Divided by that. And what you need, multiply it. Normal mathematics rules. Same thing I'm doing here. So, I will take profit will be equal to 500 divided by 75 multiplied by 25. So I will get here 500. I will use the calculator. 500 divided by 75 multiplied by 25. I get my profit as 167. So you can always cross check also. My profit is 167. So my selling price will be equal to 667. Now let's cross check. If selling price is 667, multiply 25% and you get 167. Clear? So I hope now you understand this basic concept of what is a profit markup and margin, because it is very essential to know this basics, and I hope that now you can use it in any of the questions in any of the subjects without any problem. Okay, anyways, we were on costing and we understood the first type of cost, which is direct and indirect cost. Let's look at the second type of cost. The second type of cost is based on the, the function of the cost. So that is not on the function. This also be say as based on the nature of the cost. So the nature of the cost can be three types. Okay, first is it can be a fixed cost. Second, it can be a variable cost. Or third, it can be a semi-variable cost. First, let me give you an example of all these and then I will explain you here. Excuse So the first thing that we will take up is a fixed cost. What is a fixed cost? A fixed cost is a cost like rental amount that you pay to your landlord. So let's say you have entered into a rent agreement to pay to the landlord 7,000 every month, right? 7,000 every month. So now whatever happens, every month you will pay 7,000. Let's say you are not there in your flat for 2 months, then also you'll have to pay him, correct? So you will pay him even then. So that becomes your variable cost. That is whether you're there in the flat or you're not there, rent is the fixed amount that you have to pay. That is a fixed cost. So like for a factory also, if there is a, whether you sell 10 products or you sell 100 products, if the rent of the factory has to be borne, right? And that is a fixed cost that will be borne always, right? So that is going to be borne whether you are making 10 products or 1,000 products, depending upon the capacity levels. So if the capacity of the factory is that you can manufacture 5,000 units, so up till 5,000 units the rent amount will remain same, because only when you need more space, so you will take a bigger factory or a bigger space or an additional space, then you would need to incur more rent. Otherwise, till your needs are met with this capacity, the same rent will be incurred, correct? So therefore, fixed cost, I can give you an example, right? Rent cost. Variable cost variable cost is like my direct cost. Because like I gave you the example, say if I'm not manufacturing the pencil, I don't need to incur the cost. So if I'm manufacturing the pencil, only then I will incur the cost. Let's say my factory is idle, it's vacant. I'm not doing any manufacturing activity. Then there are some people that I will still hire, right? I need to keep them. So that is like my fixed cost. But I don't need to have the material with me to manufacture because I'm not doing any manufacturing activity. So I can save on that, correct? So direct material, direct labor, like all these direct expenses which will be saved if we are not manufacturing that product will be a variable cost. But that will also depend upon the question. What is the requirement of the question? Whether that cost is actually is the cost that will be saved if there is no manufacturing, or that will still be incurred. So that we need to see as per the question. But typically I can say my direct material cost is a variable cost, because then I don't need this material to be with me as I'm not doing any manufacturing. Third is a semi-variable cost, like the electricity expenses that we have, like the telephone expenses that you have you ever seen your telephone bill? Have you ever seen electricity bill? It shows two type of components. First is the bill component, that is based on how much units are you using. So if your light is off for the entire month, you don't have any units, no expenses will be incurred for that, right? And number two is when you have, whether you are going to use the electricity or not, there is a minimum of $100, $200 that will be part of the bill every month. So that is like a fixed amount to be incurred. Clear? Clear? So the expense that has component of both variable cost as well as fixed cost, like the telephone expense and the electricity expenses, these bills, they will be termed as semi-variable cost. So semi-variable cost has the component of both a variable cost and a fixed cost. So I hope I'm very clear. Okay, any questions you can put up here, guys? I just need 2 minutes and then we will continue. Yes, guys, let's continue. So now we were discussing about the fixed cost, variable cost, and semi-variable cost. See, as we will proceed in the syllabus, we will be discussing more about semi-variable cost also, as to how can we segregate the semi-variable cost. By we use typically a method which is known as high-low method, right? So few pointers I will give you here as regards above, and please make sure that you always have hold of these points. Number one, fixed cost in total always remain constant till the capacity levels. Okay, this what does this mean? That let's say your rent amount is 10,000 a month. So in total 10,000 will remain cost over the periods. Okay, because it's a period related cost. You will I will never say that my cost per unit is, let's say, 10 per unit of fixed cost. It is going to remain constant. What is the difference? I will show you here. See, in costing we will always calculate per unit cost. We don't calculate cost for all the products. Okay, in your cost sheet that you will be preparing, always 99.9% cases you will always calculate cost per unit. So when I say fixed cost in total remains constant, it means that, let's say, we are making product A, product B, product C, and product D. Fixed cost in total for product A is 10,000, product B is 10,000, product C is 10,000. Okay, now let's not take the different products. I will take the same product but over different months. Okay, let's say this is the cost of April month, May month, June month, and July month. Clear? Fixed cost in total is remain constant at $10,000 each month. But let's say the units that were produced for April month were 10,000 units. For May, 20,000 units. For June, 15,000 units. And for July, 5,000 units. So if I have to calculate my cost per unit, how will you do? 10,000 divided by 10,000, that is $1, right? And 10,000 by 2,000 is $0.5. 10,000 by 15,000 is, now I need to use the calculator. So 10,000 divided by 15,000 is 0.67. And this is 10,000 by 5,000 would be 10,000 by 5,000. It is 2. So can you see that even though my overall cost is constant, my per unit cost is varying. Therefore, we say that fixed cost is a cost that will always remain constant in total and never per unit. Clear? Let's take the second one. The second statement. The second statement, we always say that variable cost per unit, like the direct material cost. Variable cost is simply the cost that will vary with the number of units produced and sold. Let's say, assuming there is no inventory, because with inventory the calculations are different. So let's say that you make 10,000 units, so you will need material for 10,000 units. If you are making 50,000 units, you need material for 50,000 units. Got it? If you are making 0 units, they don't need any material cost. So the variable cost is the cost that will vary with the units produced. So therefore, this cost, and these are some assumptions in costing that I'm taking. Okay, these are assumptions in costing. And these are inherent assumptions. They will always remain as an assumption with whatever costing method you choose. So remember to keep it. Okay, remember that these assumptions are to be kept firmly in your mind and you should never forget them. Okay, variable cost per unit will be is constant. Okay, so variable cost per unit is constant always. Now what does this mean? Let's take the same example again. So if I take the same example, I say that there is April, May, June and July. Okay. Now I know that units to be produced is 10,000 units here, 20,000 units here, 15,000 units here and 5,000 units here. Now the material cost that I need, okay, the direct material cost that I need per unit, will it change? No. So direct material cost that I need to make one unit is 5 kgs per unit. Okay, so whether I make 10,000 units, 20,000, 15,000 or 5,000, every time I would need 5 kgs only to make one unit. So what do you observe here? The number of units that you manufacture does not impact the material, the direct cost that you need to make the product. The cost, now this cost, when it is not varying in per unit, it is constant per unit, so we call it as a variable cost. Now you will see the total will not be constant. Here the total will be $50,000. Here the total will be $1 lakh. Here the total will be $75,000 and here the total will be $25,000. So in a variable cost, what did you observe? That your total will vary but per unit cost will remain constant. So that's what I have written. Clear? Third point is, when it comes to semi-variable cost, then please remember the cost function. This is a basic cost function that you will always keep a hold of. The cost function says that total cost is always equal to the total of fixed cost plus variable cost. Always. You will say, ma'am, semi-variable cost is not written here. Yes, because when it is a semi-variable cost, then I need to segregate it into variable cost and fixed cost. And how will I do it? There is a method through which we do it, which is known as high-low method. This I will explain in detail when we do that topic in the class. With more examples, I'll explain it. Okay, now please extend this formula also. You would be needing it at a lot of places in PM. Okay, so fixed cost, you know, in total remains fixed, but variable cost per unit remains fixed, right? So therefore, I can write it as variable cost per unit multiplied by number of units. I can extend this formula. So that means if my number of units change, my total variable cost will change. And accordingly, my total cost will change. Correct? And remember guys, when we use high-low method, I would use the total cost function only. So don't forget that. So now people, we have done about the type of direct and indirect cost. The other type we have discussed is a fixed cost, variable cost and a semi-variable cost. Let's go further into it. And now let me discuss about the different kind of costing methods. I will not discuss them in much detail because we will cover them in the relevant topics and with more examples we will be covering them. But I just want to touch them upon. Okay, so let's just touch them upon once. So now here you must have heard about these terms like absorption costing, ABC costing method and marginal costing method. First and the foremost thing, please understand, these are the methods to allocate the overheads. Like you have any production overheads, you want to allocate the production overheads to the product cost. So these two are simply nothing but they are overhead allocation methods to the product cost. And which overheads we allocate? Production overheads. Okay, so they are simply the production overhead allocation methods to the product cost. And I will take them in detail in the topic that we are covering day after tomorrow, that is precisely absorption costing method and ABC costing. So I will take them in detail that how do we allocate cost with an absorption costing method and ABC costing method. Okay, now just marginal costing method, I will just touch it here because I will take that portion also. Understand that normally a business has a perspective that they want to ensure that they are controlling the total cost, and then on that they add profit, and every business maximizes profits, right? But when we are in the marginal costing environment, this under this method, the economist has said that look, fixed cost is the cost that we cannot control, because if rent has to be incurred, it has to be incurred, right? You cannot say that okay, this month I was not staying in the house, so you don't take 10, please take 2000. I'm just using one room, so please take 3000. You cannot do that, right? So there is a fixed cost that you cannot control. So it says that why do you want to focus on fixed cost? So marginal costing method simply says don't focus on fixed cost. It says focus on variable cost. That means what? It simply says that a business should not aim to maximize profit, because profit means you are already accounting for fixed cost, but you cannot control that cost. So here marginal costing funda says businesses should aim for maximizing contribution. Okay, what is contribution? Just let me draw the cost sheet. You have variable cost. Let's say you start with selling price. You reduce your variable cost. When you reduce variable cost, you get contribution. Contribution is nothing but sales less variable cost. From contribution, when you reduce fixed cost, you get your profits. So there are two ways of calculating the contribution. First way is selling price less variable cost. Second way is fixed cost plus profit. Both ways you will get contribution. Now you will say, ma'am, what is the relevance of contribution? See, if a business maximizes contribution, the more the contribution, they're trying to control their variable cost more. So the more the contribution, the more they will be able to cover the fixed cost, and hence their profits will automatically be maximized. So here simply says that why do you want to, use your efforts against fixed cost when it is practically something that you cannot control? So instead use your efforts against the variable cost. Okay, because variable cost is something that you will have control on, and hence aim for maximizing the contribution. Aim for maximizing the contribution so that your profits will eventually be maximized if your fixed costs are covered properly. So marginal costing simply talks about maximizing the contribution. Now let's look at the book for some portions, and then we will be doing a question as well. So this is the book that would be made available to you, the chapter when you are there for the sessions, it will be uploaded and it will be given to all of you. Along with that, in the classes, you will get your hard copy of the book as well. And these are custom created books that are typically having probably all the questions that can be covered for your exams, be it from BPP, Kaplan, Study Hub, and the other materials also. I mean, so that I have tried to create a question bank that gives you ample question practice. Okay, look here. So here we are covering the basics, like what is the purpose of costing that we have covered, and yeah, the standard costing, what we prepared was a standard cost sheet, like I gave you the example here. So what do I mean by standards? Now you know that, see, we have to calculate the cost of the product beforehand only. Let's say you want to buy the product, like even without the car dealer has sold you the car, you ask and go for the price, and they give you a price that look, the price is around 10 lakhs. They have done their cost work based on which only they have added profits, and then they gave you the selling price, correct? But the product, let's say, is not yet manufactured for you, they have just taken advanced orders, and it will be still manufactured and then it will be delivered to you, but cost is already known to them beforehand, because we do estimations, we do expectations, okay, and based on which we create the cost sheet. So that is always known as the standard costing. Standard means the targeted, the budgeted cost sheet. Okay, budgets generally is a term that you use for everything like cost, selling price, and the margins, everything. But for costing, typically we use a separate term which is standard. So when I say it is a standard cost, it means it is a budgeted cost that the management has budgeted and which is basically accounted for in your accounts. And then I will tell you if there's a difference between actual and the budgets, then how do you account for? So that I will take up in the absorption costing chapter. Okay, so now here just please understand quickly that the standard costing is typically, a standard cost is a pre-decided cost per unit of a product or a service which is set under the normal working conditions. Okay, so under the normal working conditions, this cost is set by the management so that the product cost can be determined. Okay, now what are the purposes of setting this cost? Why do you think the management purpose sets this cost? One is very, very clear that I'm completely understanding, to set the pricing of the product. Yes. To do inventory valuation. Yes. Another thing is, see, every manager has to be given targets. Every employee, the product heads, they have to be given targets, because unless they are given the targets, they don't know, we are not able to really check whether how they have performed, right? So in order to evaluate their performances, we need these targets to be met. So what do we do with the standards that we are setting? We set the targets. Against these targets, we compare the actual performance. So the difference between targets and the actuals give rise to variances. Now these differences can be favorable for the company or can be adverse. Favorable means what? That let's say the target price to buy the material from the market was $10, but the manager bought it at $8. So they are saving money for the company, right? It's a favorable variance. But let's say the manager bought it at $12. No, it is adverse, because by his action, the company has to actually spend more, right? So it is an adverse variance. So then the entity needs to scrutinize and needs to take control actions, that as to why the targets were not met. And many times these targets are, and these variances, they are a criteria for the manager to have its appraisals done, performance evaluation also done. So if it is an adverse variance, probably he will have a negative performance evaluation, may not get bonus and the increments, right? So it is also testing area for them. Clear? So the targets that you set is actually playing a role towards control actions also, in a way, so that variances can be minimized, and next time the variances are even more minimized. So you can see many companies, they fire the employees because they need to have cost control. So they know about their cost only when they compare between targets and actuals, and then they actually realize, okay, the actual employee cost is really high, so let's try to eliminate those employees that are not really doing any value addition to the company. So they, by that approach, they do the firing method. Okay, so this is what is a controlling action. Definitely standards that you set are a part of your planning action, because they are budgets, and budget is always a part of the planning that we do, right? It's a planning tool. Then performance measurement of the manager, like I discussed, inventory valuation and accounting simplification. Why? Because like I told you, when you set these budgets, what we account for in the P&L account is this cost only. So you will say, ma'am, what about the actual cost? I will take in that session on day after tomorrow, that if there's a difference between this budgeted cost and the actual cost, then how do we account for that? We will be doing it in absorption costing. That is when we'll understand about over absorption and under absorption. Okay. As of now, just understand the relevance of standard cost. Now, let's go further. So, of course, the question arises, in what situations you will find standard cost to be better applied? In the situations where they are similar products, or we call them homogeneous products. The reason being, if the products are different, like customized products, then you will not have a set cost for each time you are making that product, right? Because as per the customizations, the requirements will change, the inputs will change, so the cost can change. So standard cost is typically more useful when you're making a similar kind of a product, like you're making only the Johnson baby shampoos. So every time you're making the shampoo, it is the same product only, right? Similar kind of product, and it is made in quantities. So then standard cost does make a sense. Now, when I take up standard costing, now people, there are four types of standards that we cover. One of the standards are ideal standards. I mean, these are the four type of targets that a company can set. One is ideal standard, another is attainable standard, third is current standard, and fourth is basic standard. Let me take an example for each of them and then we will understand. First, I will take the example of ideal standards. Ideal standard simply means that here there is no room for any errors, any losses. There is no room. Okay, no mistakes, no errors, no losses, no lunch breaks, no machine breakdowns, nothing. It's absolutely ideal situation. If everybody is working in the most ideal way, efficiency levels are high. So the targets are set. No, I know what you must be thinking, ma'am. These are impossible to achieve. Yes, they are actually very demotivating for the employees because it doesn't give them any space. But then also, why do you think managements may be setting this target? So ideal targets is set by companies like Toyota. Yes, because for setting ideal targets, they need to have some other areas also, focused. Like the other management techniques are also in place, like JIT and TQM. So I will just link here three things: ideal targets or ideal standards, and I will link it with JIT, and I will link it with TQM. JIT is also adopted by Toyota. You all know about this car manufacturer, right? Boeing is also now adopting JIT. So JIT simply means just in time. That means when they need inventory, their licensing is so quick. I have an order, I need inventory by tomorrow or by evening, supplier will supply me. So they really don't maintain any stock in their business, in their company. That has got materials and that is put in the system that supplier A is having 100 units, supplier B is having 2000 units. Like that, they will update the system and accordingly the supplier is asked to supply the goods, right? So it's a real time updation that happens, and just understand the efficiency, that there is no need to maintain the inventory levels, and every requirement of the entity is still met, and they're able to deliver the goods well in time to the customer, right? So this is what happens with JIT technology. Just in time, when you need the goods, that time they are there, and this shows high level of precision and efficiency. Now next is TQM, is a management approach that says, it's already there in the notes, okay, that says get it right the first time. That means please don't wait for multiple chances and then we say, okay, then improvement will take place. No, you're understanding the topic right now. Understand it completely right now. Don't wait for, I will hear the recording again and then I will understand it. No, get it right the first time only. Just when you're listening to the record to me right now, get it right that time. Toyota also works on this technology and this methodology that simply says that they want to raise the efficiency levels of their machineries and the labor so much that the first time that they're doing the work, there is no error. There is no scope for error, and it is right the first time only. And they also work on the methodology of continuous improvement. That simply says that what levels are you today, improve it to the next level. So I think all the Japanese companies, they work on this methodology where they say that there has to be continuous improvement. Okay, there has to be continuous improvement all the time. So whatever methodology they are working on, every time, every activity that is done on is should be improved as to the earlier activities that were done in the same way. Okay, so continuous improvement and get it right the first time, that is TQM, total quality management. And just in time says JIT, just get it right the first, I mean just in time, that is when you need the inventory is at your doorstep, at your factory, and you really don't have to maintain the inventory and stuck your money over there. So now I was coming to ideal standards. So just understand, an entity can only have these ideal standards in place when they have JIT and TQM also with them. Because only when the efficiency levels are very high, the inventory requirement is minimized, and everything is completely streamlined, no machinery breakdowns, no lunchtime, then only we can have the ideal standards in place. But it is very difficult. If your entity is not working at full efficiency, then it is going to demotivate the employees, and instead of trying to achieve the targets, they may just fail to achieve the regular targets also because of the demotivation. Let's take an example. A car factory sets a standard that one worker should produce 10 cars per day, assuming no breakdowns, no sick leaves, no mistakes, and no waiting time. Right? So that is very, very, very difficult to achieve. And, and generally, then ideal standards are more relevant for long-term goal perspective rather than short-term goals, because then the short-term profitability of the entity may be affected. Now, next, attainable standards. They are practical standards. Let's say that the entities last year actual sales was 2,000 units. Now the management has given them a target of 2,500 units. So now it is a motivation force for the employees, because now they feel connected with that, right? They think, okay, let's just put in little more efforts and we will be able to achieve it. So then it becomes a practical standard. It becomes a standard that typically they find themselves to be connected with, and it kinds of gives them motivation, a driving force to achieve. So it is the targets. It is these are the kind of standards that ideally the entity should be fixing. Okay, because it motivates the employees and pushes them to achieve the targets. For example, so generally it is more realistic, and it is the ones that are commonly used across businesses. For example, the same car factory now sets a target of 7 cars per day, not 10 cars per day. So when they have set a target of 7 car per day, now they are taking into account the small machine breakdowns, tea breaks, and minor defects. They are not giving too much of space also, because now they know that this much is acceptable levels that the employee should maintain. Third is basic standards. See, when an entity is going through a tough time, a rough time, economy is going through a bad time, or when the entity wants to look from a very, very long-term perspective or a planning perspective, then they set basic standards. Basic is the minimum level that they need to, sell, for example, to survive in the market, the minimum levels. So of course, it is also very demotivating. Let's say you are already at 2,000 units and now you want to give a target of 1,000 units. So this is demotivating. But then generally it is not used as a targets to be given to the employees. These are generally used for planning purposes. When an entity is doing planning for the future, they look at that what is the basic levels that they need in order to maintain in the industry. For example, a restaurant sets a standard, a textile company fixes the cost of producing 1 meter of cloth at $2 in 2010 and keeps this figure unchanged for years. For example, when you have the indexes, you have an index for, let's say, this year, it will remain unchanged for 10 years. So that is the basic standard. I mean, because with the time, that is lapsing, of course the standard should increase. So if they're keeping same, that means they need this much to be actually at least catered to whatever the crisis the entity is in. Now, next is current standards. I mean, it is practically again not a very motivating one, because this is generally that you are remaining in the business. So, yes, for preparing budgets, we need these standards because we know the current levels according which the expectations are created. Okay, for example, a restaurant sets the standard cost of making one pizza at 5.5 for the current month based on today's ingredient prices. So if cheese price, for example, which is a part of pizza, rises next month, the standard will be updated accordingly. So current standard is what is the current levels, accordingly what is the current target price as of today. And if there are really changes that takes place in the future, then accordingly standard also needs to be updated. I've taken a very good real world example, guys, and this example is to highlight, like, you must have seen, for example, when I go to McDonald's, I'm buying a burger maybe at 40 rupees in my country. Okay, but when I'm placing a corporate order of maybe 5,000 burgers or 2,000 burgers, now the same burger is being made available to me not at 40, but at $32. And I want rupees 32. And I wonder that why suddenly from 40 rupees it has come down to 32 with the same item, same ingredient, same taste. So without compromising on quality also, how did they offer me 32? Because what they looked at their variable cost. So here also I will just tell you this pointer. Okay. Yeah. So they looked at their variable cost, which means that when they are fixing price for the product, it is not always necessary to try to cover your fixed cost. Based on the marginal costing concept, even variable cost can be used. Along with that, maybe margin can be added to calculate the selling price. Why? Because McDonald knows that from the fixed cost is the cost that will be still be recovered from other products and the regular orders and the regular sales. But this is like a one-time order on which they can earn. So they fix a price which is competitive and which is based on the variable cost. So like this, variations can be brought in. Now, one example I've given here for McDonald's for the standard pricing and the standard cost. Look here. Restaurants traditionally founded that why do you think McDonald's became so successful? It is a secret that I've given you. Restaurants traditionally found it difficult to apply standard costing. Why? Because each dish was slightly different from each other. But what did McDonald's do? What did KFC did? Okay, what they did? They brought standardization that each time you place an order from any outlet in the country or worldwide also, typically you have the similar taste. So they brought standardization in taste, and due to which they could set the predetermined price, the rates and the standard cost. Since they could know their cost in advance, setting a price which is competitive was much easier for them. So they actually practically started in the food industry the concept of standardization, which until before then this was really not practically possible. And you know that there is a very reduced amount of human intervention here. Even when the staff gives you cold drink in the glass, they only give you the amount from the dispenser which is mentioned there, and the machine is already set for the same. So the staff cannot increase that amount, right? So there is minimal human intervention. They are just there to serve you. The cooking and everything, how much quantity will be going in the manufacturing or the you can say making the burger ready, it's already machine controlled, right? So everything is already predetermined. So it was a big revolution in the food industry with McDonald's. Okay, quickly the structure of cost sheet we have already covered. Absorption costing, I will cover in the lecture on Thursday, and then I will cover the difference between marginal costing and absorption costing also, guys. and we will cover the budgets, we will cover controllable cost. All these concepts also we will cover on uh, Thursday session. Now let me just take up one question for today, and remaining questions we will be covering in the Thursday session. Okay, Thursday session is very important. I will highlight where I'll cover ABC, a brief up, for ABC costing. Okay, we'll cover the ABC costing. We will cover absorption costing, the difference between absorption and marginal costing, and also highlighting on the budgets, as well as we will be discussing on controllable cost, doing questions for the same. Tomorrow's session, I will cover life cycle costing and target costing. Okay, these two are the targets for tomorrow. So do join the class on time, and the links will already be there on the YouTube channel as well as on my Instagram page, the Telegram, everywhere the links will be uploaded. Okay, and please join the Telegram channel if you want to get access to these notes. This free material will be provided to you on my Telegram channel. So if you have not joined the channel, please join it today. If you have not subscribed to my YouTube channel so far, then I request you to subscribe it now so that you don't miss on any content. Okay, let me take up this question so that we are completely clear with this topic. So this is the preparation of a basic cost sheet. K Limited makes two products. Information regarding one of these products is given to you. Budgeted output oblique sales, that means the output is 900 units. This budgeted output is only given to you for your fixed cost purposes. Sorry. The standard details for 1 unit, like I told you, that you will always have your cost sheet for 1 unit only. So you always have per unit cost sheet. The direct material cost for making 1 unit is 40 square meters at 5.3 per square meter. And direct wages, there are two departments that it will be going through. So two direct wages are there for the labor involved, bonding and finishing. Variable overheads are there, right? Just like we have the fixed cost and the variable cost, in indirect cost also I have a variable overhead and a fixed overhead. Fixed production overhead is given to you, fixed non-production overhead is given to you. Now you know why it is constant, because in total fixed cost remains constant. Variable overheads are recovered using hours, fixed overheads are recovered on a unit basis. Hours means based on the labor hours, we will be recovering the variable overheads. Prepare a standard cost card for 1 unit. Enter on the standard cost card prime cost, variable production cost, then total production cost and total cost. Also, we need to fix the selling price by allowing a profit of 25% on selling price. So this is the profit on the margin, right? Got it? So now here you will use the format that selling price is 100, profit is 25, so cost is 75. Because what you will work out here is total cost that you will make equivalent to 75 and accordingly calculate the profit, which is 25. Clear? Let's start doing it. So first I will write down the material cost. Then I will write the direct wages cost and I will get my direct cost. Okay, which is the prime cost. Direct material cost, 1 unit requires, and this is per unit. 1 unit requires 40 square meter and each square meter is 5.3. So total is 212. Now for direct wages, I have bonding department and I have finishing department. Bonding department requires for making 1 unit 24 hours and each hour is at $5. So it becomes 120. Finishing department requires 15 hours to make 1 unit and each hour cost is 4.8. So here my labor cost is 72. That's all. There is no direct expense. So add it and you get your prime cost. Prime cost is the total of all the direct cost. So prime cost will be 120 plus 72 plus 212. I get here 404. Now the next requirement of the question is to get the variable production cost. So with prime cost, when you add the variable overhead, because direct material is variable, direct wage is also variable, right? Because the cost constant given to you is per unit. So that is giving me an indication. Got it? I just need to add variable overhead and the total I will get as the variable production cost. So variable overhead I will calculate for both bonding department and finishing department, because it is given here that your variable overhead is 1.5 per bonding labor hour. Bonding labor hour is 24. A finishing department is one a variable overhead for finishing is $1 per finishing labor hour. Finishing labor hour is 15. So simply multiplied. So for bonding, I will multiply 1.5 multiplied by 24. I get here 36. For finishing, I will multiply 1 multiplied by 15. I get 15. Now you add it total with the prime cost. So you will get your total variable production cost. Okay. I need more space. So I will write here variable production cost. That will be 404 plus 36 plus 15. And I get here 455. Now question wants me to get the total production cost. So with this I need to add the fixed production overhead. Only production, because it only wants total production cost. So I will not add non-production first, I will just add production cost. But then mistake by the students when they add 36,000 in total. Boss, we are preparing here per unit sheet. So how will I get cost per unit? What I told you, fixed cost varies with the capacity. Capacity means targeted units. The question gives you here that the targeted units are 900. So what is the fixed production overhead? 36,000 divided by 900, which will be equal to 40. So you just add 40 here because we just need the per unit cost. Okay. Now, so I will take total as 40 plus 55. Okay, let's add it. 455, so I get 495. This is my total production cost per unit. Now I need to get total cost, so I just need to add fixed production, non-production overhead. Okay, so I will add fixed non-production overhead. What is the fixed non-production overhead? It is given to me here 27,000. Again, I will divide it by 9,000 to get the cost per unit. So 27,000 by 900, I get 30. I will write here 30 and it becomes 525. So this is my total cost. Now you know the cost, you know the format, that selling price is 100, profit is 25% on it, cost will be 75. So accordingly add the profit. So profit, how much will you take? You will equate it and you will take 525 is the cost divided by 75, which is the equivalent value. You need the profit value, which is 25. So multiplied by 25 and you get here 525 divided by 75 multiplied by 25. I get here 175. Got it? Now you add the two and you get your selling price. So selling price will be 525 plus 175 and you get here 700. So I hope I'm very clear with the preparation of these cost sheet and with this concepts of basic concepts that is coming from MA, and I'm sure now absolutely crystal clear you guys are. The remaining portions I will take it in the Thursday session, but don't forget to attend tomorrow's session on life cycle costing and target costing. So see you guys tomorrow for these two topics. And if you have any questions and queries, feel free to put it in the comment section and I will revert back. For any more details about the classes that are going to take place, please visit on www.bbvirtualsglobal.com. And also don't forget to like and subscribe the channel. So see you guys tomorrow for life cycle costing and target costing. Thank you. Bye bye.